It's time for All Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now, with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain, and I hope you had a great holiday season, Christmas and New Year, and welcome to the year 2011. This is our inaugural show of 2011. We'll be continuing with our market, stock and bond market, economic, inflation, all things money outlook for 2011 during the show. Before we get going, let's give you our phone number, which is 252-633-0107. Our email is allthingsmoney@dlblain.com. And of course, our website is www.dlblain.com. There you'll find information about myself, my company, and most importantly, archived copies of the show. If you happen to miss our show from December the 21st, which is our last show in 2010, you can always go back on the web and download a copy and listen to it. For the benefit of those who were not able to hear that show, we will give a quick recap of what we discussed. First of all, the global stock market in 2011, we expect the global uptrend to continue, at least for the first half of the year. We would expect for emerging markets to continue their outperformance in general, although if we have time, I'll get into some of the results for 2010. The S&P 500, the U.S. market, actually outperformed the broad-based emerging markets. That's mostly due to the weakness of China and Brazil, which make up the majority of the emerging markets index. But there's still a tremendous amount of opportunity in individual countries in emerging markets. Some representative countries that you may want to look at: Peru, Indonesia, Thailand. Those are three of our favorite countries. Beyond China, you have India, Hungary, the Philippines, Russia. Colombia has been doing very well. These are some other emerging markets that you may want to take a look at. The northern European countries, such as Norway, Sweden, Finland, they also had a good 2010. We do expect that the global uptrend, the cyclical bull market that is currently in place today, will begin to crack sometime in 2011. As I said in the previous show, there's one thing we can definitely say about predictions and outlooks and things like this with certainty, is that we will see major developments in 2011 that nobody foresaw, and these are the events that will drive the stock market, the bond market, inflation, and things in the year ahead. So when we look at these outlooks, I don't want to say it's completely useless, because I think there's some valuable insight that we give based on what's going on in the economy, interest rates, looking at historical information. But keep in mind that the most certain thing that I can tell you is that it's the unanticipated developments and how investors react to those unanticipated developments that always drive returns. So what we do is we go along in our outlook, and I try to give you things to look for, that if the scenario as we expected is not unfolding, what to look for that would indicate that something is changing. Okay, so we're bullish for now. We expect a peak probably in the second quarter or the summer sometime. At some point, this cyclical bull market will definitely slow down. It's gone on longer than the majority of cyclical bull markets to this point. So we want you to watch for interest rates. A little bit of interest, a little bit of inflation is good for the markets. A lot is bad. So we want you to keep a lookout for interest rates, and as interest rates rise, you should begin to have some caution, especially with the stock market. Of course, there could be other economic shocks to the system. The spring of 2010, it was the Greece crisis that really weighed down on things. But we think that the rise of the emerging markets in Asia will continue. China has been having some problems. in recent years, it has been a leading indicator, so we want you to keep an eye on China. If their relative strength of their market and economy continues to deteriorate, that would be a good indication that the cyclical bull may be coming to an end. If you're into the actual levels of the market, the S&P 500, we look for a peak somewhere in the 1540 to 1580 range. We would look for a downside level between 1215 and 1275. In terms of volatility, we do not expect anything near what we had in 2008. So if the markets do start to drift downward, move downward, we would not expect the type of volatility we saw in 2008. However, it's something to keep an eye on. Keep an eye on the volatility of the market. If it is rising to extreme levels, you want to be cautious with your investing. So that brings us to the end of the show that we covered in December. A broad overview of the markets, global trend intact. Through mid-year, we would expect a mid-year peak. So now let's get into some new information. Let's talk a little bit about style. By style, we mean growth versus value companies, large versus small companies. In different types of economies, different types of markets, you see growth companies outperforming. Sometimes you see value companies outperforming. Sometimes large, sometimes small. So in concert with what we feel is going on in the global markets, we are currently emphasizing your smaller companies and growth companies. They are the ones that are currently outperforming. We would expect that outperformance to continue at least into the mid-year. Another factor that we look at that doesn't get a lot of press is what we call payers versus non-payers, or high quality versus low quality stocks. You're probably familiar, you've heard the growth versus value, large versus small. Well, one of the important factors that we study is whether a company pays dividends or does not pay dividends. Along those same lines, we classify companies as high quality and low quality. And in bull markets such as we're having now, you see the non-dividend payers and the lower quality stocks, people just pouring money into these companies. As markets tend to, as they go down, as economic conditions become poor, we see that dividend payers and higher quality stocks move to the forefront, and that's where you want your funds to be. So we see the first part of the year, your lower quality, non-paying stocks. When the market starts to go down, we would look at higher quality, dividend-paying stocks. Well, we'll continue after a short break with our 2011 outlook. For All Things Money, my name is David Blain.